report, the 9th of July 2025. So what's in store for us today? Right, today's sharing is about BOJ's policy dilemma and the yen's outlook in the medium term. Now, the Bank of Japan is at a crossroad. It faces the difficult task of normalizing monetary policy amid a slowdown in economic growth, even as inflation stays stubbornly above target. Now, this challenge is compounded by declining real wages and looming trade uncertainties, notably steep US tariffs that threaten Japan's export-driven economy. Now, together, these factors have created a delicate balancing act for Bank of Japan. Policymakers and global investors are keenly watching how this will impact the Japanese yen trajectory going forward. Now, the Japanese workers are seeing their purchasing power erode despite nominal pay raises. Now, inflation-adjusted real wages basically fell 2.9% in May from a year earlier, and this is the sharpest decline in 20 months. Now, this was the fifth consecutive month of real wages contraction as well, indicating that consumer prices are rising faster than incomes. Now, government data confirms that while nominal wages have increased, helped by recent pay hikes negotiated by the unions, inflation has been eating into these gains, leaving workers worse off in real terms. Now, this wage squeeze persists despite an ostensibly positive development. In this year's spring labor negotiations, Japanese unions secured the biggest pay hikes in decades. Now, the nation's largest union federation negotiated an average wage increase of about 5.25%, the highest jump since 1991. However, with core inflation running about 3.5% to 4%, well above the BOJ's 2% target, much of those pay gains have been diluted by rising prices. Inflation has exceeded the BOJ's target for over 3 years now, creating a scenario where even unusual large salary bumps have failed to keep up with the cost of living. The result is weak real household income, which threatens to dampen consumer spending and broader economic expansions. So, adding to the central bank's difficulty, Japan's economy shrank in the first quarter. The 0.2% Q-on-Q contraction was driven by a decline in exports and stagnant consumer spending. Now, the slowdown comes at a time of rising uncertainty over global trades, with the US planning to impose 25% tariffs on Japanese import. Now, these tariffs threaten to hit Japan's already vulnerable export sector, weakening business confidence and economic momentum. Now, the BOJ is basically caught between two opposing pressures at the moment. On one hand, inflation remains above target, and raising interest rates could help stabilize prices. Okay, because we have seen that for the last 3 years, Japan has been in a deflationary mode for a long time, and the Bank of Japan basically wanted to see inflation that comes from what they call internal inflation, and they're seeing it right now. Okay, and right now, not only they are seeing it, it proves to be pretty sticky at the moment, this inflation. On the other hand, a fragile economy and weak real wage growth suggests that tightening policy could risk tipping Japan further into a slowdown. Yes, right now we also have a new problem whereby inflation is higher than the wage growth. So the BOJ has long emphasized the importance of a self-reinforcing cycle of wage growth, right? Which I explained earlier, and price increases before normalizing rates. However, that cycle appears incomplete as inflation continues to outpace real income gains at this moment. And to top that, there is no unified view on what the BOJ should do next. One perspective argues that the recent drop in real wages wages is temporary, and delaying a rate hike would be wise to avoid weakening household consumption. Another viewpoint holds that with inflation staying high, the BOJ should raise rates to support the yen. A stronger currency would reduce import costs, offering immediate relief to households facing elevated living expenses. And now you also have a third opinion which suggests that the central bank should refrain from any immediate action, maintaining a long-term tightening bias while assessing trade risks and consumer resilience. Essentially, the bank must choose between tackling inflation via tighter policy, which risks a higher hit to growth, or supporting the economy by staying dovish, which leads to risking inflation staying above target and real income declining. So going forward, we must study which is the path of BOJ. Okay? So as such, with regards to the yen, the direction of the yen will closely follow the BOJ's policy choices. If the BOJ raises interest rates even slightly, the yen is likely to strengthen. A stronger yen would help reduce imported inflation and ease consumer pressures, although it could hurt exports in the short term. Conversely, if BOJ keeps rates low, the yen may remain weak due to Japan's wide interest rate differential with other major economies. However, in times of global market stress or geopolitical uncertainty, the yen could still appreciate as traditional safe haven currencies regardless of domestic policy. Okay? Now, as conclusion, the BOJ faces a complex challenge. Inflation remains high, but the economy is slowing, and real wages growth is lagging. With trade tensions on the horizon and household spending under strain, any policy move will carry significant consequences. Whether the BOJ acts decisively or opts for caution, the currency path will reflect how Japan chooses to balance price stability with economic growth. Okay? So with that, that's the report for today.